As gold drops to reset Fed expectations and stock protection costs hit a one-year low despite looming tighter conditions, there is one set of data connecting it all, and by the end of this video you will see it. Let's start with why the Fed is being forced to act. Core PCE, their preferred inflation goal, is moving higher, not lower. This is the number that drives every decision they make, and it is putting enormous pressure on the committee right now. The market has responded. The odds of a rate hike by September are now rising, sooner than almost anyone expected 6 months ago. And by December, the probability climbs even further. This is not a higher for longer situation anymore. This is a higher and getting higher situation, which is, broadly speaking, not what you want to see when markets are priced for everything going perfectly. And one of the reasons inflation is not cooperating, it is oil. Despite recent developments, we had higher oil prices through most of April, May and June, which I was warning would directly reflect in costs as a delayed effect, not immediately. Inventories are sitting at record lows. Higher oil feeds directly into the Core PCE number, which feeds directly into the Fed's calculus. This is not a temporary supply blip, it is a structural input pressure that the Fed cannot talk away. Now, gold is highly sensitive to real yields. When the Federal Reserve hikes and real yields rise, gold falls in the short term. That is exactly the dynamic we're in right now, and that is why Goldman Sachs just slashed their gold forecast. They cut their target by $500. 6 months ago they were telling you gold would hit $5,400 by year end. Now they're walking that back. The reason is simple, the Fed isn't cutting and it may be rising. In my analysis, this shaded zone on the chart defines the maximum probable downside, the precise area where I expect gold to establish a floor of a structural support. My base case is that as long as the Fed maintains its tightening cycle, this year gold will face near-term headwinds. However, my assessment of the underlying data tells me this weakness is strictly temporary. And keep that word in mind, temporary, because it becomes the foundation of the entire argument in about 2 minutes. Because gold imports globally are not slowing down, central banks are still buying and geopolitical hedging continues. And in the longer arc, gold still has a much higher role to play. The short-term pressure is real, but the structural bit underneath is not going anywhere. Before we dive into what this means for stocks, if you are finding this data-driven breakdown helpful, hit the subscribe button. We do this every week. No noise, just the charts. Now let's move to stocks. The cost of protection on stocks is extremely low. Investors are not hedging. And this is happening as global liquidity is rolling over. This leading indicator, pushed forward 6 months, is now negative and falling. The Federal Reserve's own treasury operations have dropped from 40 billion per month to just 10 billion. That is a quiet but aggressive acceleration of tightening. Meanwhile, retail is not slowing down. Option activity is breaking to new highs, and this may be precisely why the Federal Reserve wants to sound hawkish, to cool down speculation that is getting out of hand. FINRA margin debt continues to increase in absolute terms. And relative to M2 money supply, it just hit 6.19%. A level that has only been exceeded twice in history, March 2000 and October 2007. Past results are not indicative of future performance, but the historical pattern deserves attention. So we have falling liquidity, retail speculation, and historic margin debt. What exactly is holding the entire market up? One theme: AI. The situation has gotten so inflated that the US government is now mulling buying equity stakes in AI companies, essentially to make sure the stock market continues to function. Take a moment to absorb that. Semiconductor valuations are in a territory that is generally considered not sustainable without exponential earnings growth materializing very quickly. And beneath the surface, the disconnect is staggering. Look at the free cash flow projection for the major hyperscalers over the next 12 months. Free cash flow is projected to absolutely crater as they spend billions upon billions on AI infrastructure. Yet, as their cash flow falls off a cliff, the S&P 500 continues to grind higher. The biggest companies are bleeding cash to build AI, and the market is pricing them as if those investments have already paid off in full. Why is the market ignoring this near-term cash burn? Because Wall Street is looking at projections like this one. After the next 12 months, estimates have hyperscaler free cash flow absolutely skyrocketing, reaching well over $600 billion by 2030. The market is pricing in perfection for these AI bets 4 years into the future. But between now and 2030, there is a lot of room for disappointment and volatility. The Bank of America investment clock, which maps economic regimes to asset class performance, shows the cycle rotating from boom towards stagflation. The yield curve is bearish flattening. Rates are rising, and historically this mid-cycle shift has preceded corrections of 10 to 57% within 6 months. However, if the market falls 20%, this will be exactly the point where the Federal Reserve may be forced to act. Add to that, a massive stock rebalancing is expected into month-end, which could induce additional volatility on top of an already fragile setup. Here is where everything connects. When the unemployment rate sits below CPI, as it does now, history shows the yield curve steepens aggressively. It is the market's way of realizing the Fed is trapped between slowing growth and sticky inflation. We have moved from inversion last year to steepening, and this is similar to the 2022-2023 playbook. A hawkish Fed, a strong dollar, gold under pressure, and equities vulnerable. The measured move pattern in S&P 500, which I have shown in previous videos, both the larger and the smaller structure, is still technically valid. Until invalidated, it remains in play, supported by every fundamental we just walked through. So what are we probably looking at? Not a recession, but a correction in my own view. Uncomfortable, potentially 10 to 20%, and probably affecting portfolio allocations across equities, commodities, and bonds simultaneously. Gold drops or stay flat in the short term, but remember the word from earlier, temporary. Central bank buying and geopolitical demand have not disappeared. The long-term trajectory remains upward. The two data prints to watch: Core PCE on June 27th and the September FOMC decision. If Core PCE comes in above 3.5%, the probability of a September hike approaches near certainty. If it comes in below 3%, the entire framework eases substantially. The Fed is the strongest gravitational force in markets right now, and that force is pulling in one direction. But I'm sure it will be fine. If you found this useful, make sure you subscribe. See you in the next video.